Now we are going to invite Director Piers Haben from European Bank Authority for the second presentation.
Hello, everybody. My name is Piers Haben. I work in the European Banking Authority, and it's a real pleasure to be with you here today in the Seoul Asian Financial Forum, May 2021. It's great to be able to reach out across the world, even if we can't travel as we did before. At least we have the technology to engage, which is wonderful. So I work at the European Banking Authority. The European Banking Authority is responsible for setting the rules and standards for the entire European banking system. I'm a director there, and one of my responsibilities is all of the EBA's work on environmental, social, and governance issues, and that is what I'd like to talk about today. I would like to talk about why we think that environmental and social and governance issues are so important for the banking sector and why there is such heightened interest in it. I would like to talk about the EBA's role and the way that we are sequencing our work, and the sequence of our work will be a key message today. And I'd like to talk about why it's so important that we engage across the world on this important journey to embed ESG factors into everything that we do, and indeed address the great challenges we have around global warming, but also other ESG issues. Excellent. So why is ESG so important at the moment? I think we are all acutely aware of the issues around global warming in particular. We have seen significant warming in the last 40 years, and the 7 most recent years have been the ones that have contributed most to that warming up until 2020. So I think in the public mind, there is a specific issue that needs to be addressed. Of course, as prudential regulators, our job is less to achieve social goals in itself, but rather to identify and address risks and ensure that the financial sector is part of the societal aims. The way that we are doing that is, of course, paying close attention to global initiatives in relation to environmental factors. In particular, I flag the Paris Agreement, and of course, paying close attention to other global initiatives on the financial sector, such as the FSB, the Network for Greening the Financial System, and the Basel Committee. But in the EBA, a lot of our work is, of course, embedded in the context of the European Union's work as set out in the European Commission's action plan. And on this slide, I've just put in some of the mandates that we have for the European Banking Authority to try and give you a flavor of what prudential supervisors can do and how we can take that work forward in order to address these real issues around ESG factors and how they impact the financial sector, financial stability, and how that relates to societal's goals. A key message that I would like to convey here, so we see that the public interest is very high, is that from a prudential regulatory perspective, from a financial sector perspective, there is a key issue of dual materiality. So this is, on the one side, that environmental risks, social risks, governance risks can have a specific impact on both an individual financial institution and the financial sector. In the same way that credit risk can undermine the profitability and indeed the solvency of an individual financial institution. So ESG factors can, and I'll talk in a moment about the transmission mechanisms, but ESG factors can have an impact on financial soundness. So that is one impact for ESG. But there is this, because of this dual materiality, there is also the very important impact that banks and the financial sector can have on society. And I think this is a key issue for us to reflect on, the dual materiality, because of course, as prudential supervisors, we are worried about the solvency and resilience of the financial sector as a whole from the perspective of financial stability. But banks that are lending into the real economy also have then this impact on society. And whether banks are drivers of or reflections of our economy, it's vital, I think, and there's a wide range of stakeholders that have an interest in the way that ESG factors are interacting with banks' risks because of on the one hand, the impact on individual banks, and on the other hand, the impact on society as a whole. And I think that range of stakeholders is then very wide. Now, how do we go about, from a prudential regulatory perspective, then, taking forward this work on ESG? Normally, when we think about prudential regulation, we think firstly about what we call the Pillar 1 rules, so the capital and liquidity rules. And I think the audience in Korea is very familiar with the Basel Committee, the Basel Accord, and the capital and liquidity rules there. So normally we start with these Pillar 1 rules, then we think about how those rules are assessed under Pillar 2 and any other risks addressed, and then we think about disclosure under Pillar 3. I think an interesting factor from ESG is that we have reversed the sequence in which we are doing this work. So we are starting with our Pillar 3 work, thinking about metrics and disclosure. Then we are moving into our Pillar 2 work, thinking about risk management and supervision. And it is after we have done those things that we will be thinking more about the Pillar 1 work, thinking about potential risk differentials based on ESG factors. And why have we changed this sequence? And the reason we have changed the sequence is because we really have a very difficult starting place to look at ESG factors in relation to the financial sector, because we have a lack of data, we have a lack of metrics, we have a lack of methodologies for assessing the risks of ESG factors on the soundness of individual institutions and the sector as a whole. So in that absence, we thought it was imperative that we start with the metrics and think about disclosure, then we move into risk management, and then we move into understanding Pillar 1. And the sequence today of my presentation will go through Pillar 3, Pillar 2, and then Pillar 1. And to my mind, there is an absolute necessity now to start thinking hard about metrics and to start thinking about how we can use those metrics then to address ESG factors. So on this slide, I look at some ESG type disclosure initiatives. Well, so I'm going to start the sequence by going through the Pillar 3 part. And Pillar 3 relates to disclosures. And it's absolutely imperative, I think, that we start with understanding the metrics that we have and ensuring there is effective disclosure. Without key metrics, we can't do the work on risk management. We can't understand how the solvency of an individual institution can be affected. So it's imperative that we start with metrics. And metrics are also key because of this dual materiality issue. So we need metrics to understand the risks to a bank, but because of the dual materiality issue, it's also imperative that there is some disclosure of that, so all relevant stakeholders can understand the kind of risks facing an institution and collectively facing society. Now, from our perspective on disclosure, it's imperative that we start from an international perspective, which is why we've paid close attention to Paris alignment, to the work of the G20, to the work of the FSB, TCFD. So we started our work on disclosure from the starting point of the FSB, TCFD recommendations. But of course, those recommendations are incredibly useful. But at an individual entity level, it's important that we get to perhaps more granularity in terms of the specific metrics that are needed. So on one hand, we need to be consistent internationally. We also need to think about the position of individual financial institutions in relation to their customers and getting the right data. So not only do we have to be aligned internationally, we have to be aligned in terms of asking for similar data from corporates, from financial institutions and other customers. So that's why in our disclosure work, we started with the FSB work, but we've also done a lot to ensure that we have a common framework for all of the disclosure across the economy. And that common framework starts with the EU taxonomy. And this is a series of definitions of environmentally sustainable activities that are Paris aligned. And that is, in effect, the bedrock for everything that we are doing in relation to ESG. And that taxonomy applies in our Pillar 3 work, and I'll explain in a moment how that drives the green asset ratio. But it also applies equally to the non-financial reporting directive, which is a tool that we use to get all corporates across the EU to disclose relevant ESG information. And it's in this way, and I'm sure it's exactly the same challenge in every jurisdiction for the audience today, that we can start to build these data sets that will allow us to have an understanding both of the risks and of where we are in relation to green lending today and where we hope to be in the future. So building this, if you like, matrix of work is absolutely key. And going forward, we will then need to take forward this work. Certainly, we will need to think about how to build this into, for example, accounting standards. And again, we will need to do this both at a European level, but also step out and think how we can find common ground internationally. It's not clear to me that we will always find all of the details of every taxonomy to be completely aligned, but it is imperative that we find the bridging points so that we can understand the disclosure of key metrics such as a green asset ratio, such as physical and transition risks, which I'll explain in a minute, in at least a comparable way globally. Just to give you a slightly deeper flavor of the links between the work that we have done on the taxonomy and what we're expecting from corporate disclosure and what we're expecting from bank disclosure. This slide shows you a little bit more as to the work that we are doing, because our Pillar 3 work will become applicable from June 2022. It applies to large banking institutions, and it requires them to disclose their risks as well as their risk mitigants. And at the same time, we have worked with the Commission, and we've given them some advice on this, to ensure that all corporates, all large corporates, are required to disclose taxonomy-aligned activities. And the final delegated act for this was just produced in May 2021, which will ensure that large corporates disclose their green asset ratio, which will help banks in turn. A point I would like to make here is that we have deliberately sequenced this work. So we have focused the disclosure part on the E part, the environmental and specifically the climate change part of disclosure. And of course, we will have to build this out in time to cover other environmental, social, and governance risks. But specifically, what are we asking banks to disclose? Here, I think it's very interesting because we have this alignment on the green asset ratio. You will see this in the slide, the third sort of section down there. That is the part that we will get very clear alignment. But we're also asking banks to disclose their risks. And so we will be asking banks to disclose their climate change transition risks. So this is, for example, your exposure to industries that may over time become stranded assets. And I know you've talked about this elsewhere in the conference, stranded assets, but as public policy changes, it may well be that certain industries are no longer viable. And so understanding the climate change transition risk will be key from a dual materiality perspective, both to the solvency of an individual institution, but also then the lending to those sectors is interesting, I think, from a societal impact if there is public policy moves to step away from those types of sectors. We will also be asking banks to disclose their climate change physical risk. So this is about the risks if you are lending to, for example, a floodplain and we have global warming and flooding becomes more common. What is the kind of physical risks you will be exposed to? Again, I think also interesting from a societal perspective. Secondly, then we will be asking banks to explain mitigating actions. And these are mitigating actions that might not meet the exact Paris aligned activities, but are designed to reduce the impact from some of the activities that may already be harmful. So examples are supporting the transition through building renovation loans, supporting adaptation through loans to build barriers against flooding. Sometimes these mitigating actions will actually fall under the taxonomy aligned activities, but we needed another category to ensure that we didn't have a simple binary green and other category. It's vital that we understand there is a gray area between pure Paris aligned goals and pure carbon intensive activities. And so we have an area of mitigating actions. Then this third area is what we call the green asset ratio. For me, this is a key metric. I think it's a key metric that is of great interest to banks' own management. It's a key metric that is of great interest to supervisors, but also I think from a societal perspective, there will be many stakeholders interested in the green asset ratio. The green asset ratio would tell you what proportion of loans are aligned with, in the EU, the taxonomy aligned activities, which in turn are aligned with Paris Agreement goals. I think it will be very important that this number is caveated very carefully, because the green asset ratio really reflects banks' lending activities, but in turn reflects then the nature of the economies within which we are working. And to my mind, the key point about a green asset ratio will be to understand then how the risks are being mitigated by lending to taxonomy aligned activities. And that's a key reason we think that the green asset ratio must be part of risk disclosure. But it's also a way of understanding where we are today, both for individual institutions and for the financial sector as a whole, and mapping a sort of compass point or a North Star to allow us to understand where we may go in the future. So what strategies are being set to move towards more sustainable lending, and are we on track to meet those strategies? So the green asset ratio is key. Equally, we will be asking banks to disclose qualitative information on their governance arrangements, their business model and strategy, and their risk management. And maybe that allows me to move quickly into the Pillar 2 part of the work that we are doing. So the work that we're doing on Pillar 1 is live right now. We have a consultation out. That consultation ends in June of this year, and then the disclosure requirements come into effect in 2022, making sure that we have information from corporates flowing to banks, and then they disclose. I should note one final point on the disclosure, which is that we know that it will be hard for banks to get the information, which is why we are saying and providing some timelines that where they don't have all the detailed information, they should look to proxies and estimates in the first instance for a limited time in order to ensure that they have some meaningful disclosure and are able to use that for their own internal risk management, but also to inform external stakeholders about their risks and about their strategy. So proxies and estimates will be important. So moving into then the Pillar 2 work that we are doing. The timelines for this are a little bit longer. We have done some work already with a discussion paper. We will planning to have a report on ESG risk management and supervision in June 2021. And that report will be the basis for future work to improve risk management in banks, to adapt supervision to pick up ESG factors. And one question we are often asked is, well, aren't ESG factors just the same as any other risks? And therefore, why do you need to have any special risk view? Well, I think there's a couple of reasons. The first is that the time frame for ESG factors to impact both profitability and solvency can be much longer. So whilst we tend to look in 3 to 5 year cycles, for example, on credit risk, it is quite possible that you need to look forward over 30 years to understand how physical and transition risks will impact a particular financial institution and financial stability. Secondly, I think it's that the ESG factors tend to have channels of impact and transmission channels of impact that it's important that we understand. So it's important that we understand what sort of data that we need, because it might be new data, and it's important that we understand then the metrics that we identify, how they relate to financial indicators. So firstly, the time frame is different. Secondly, the transmission channels might be different. And thirdly, back to this point about dual materiality, I think it's also important that we understand that the data and the metrics are important, not only for individual financial institutions, but also for the wider societal impact. And the kind of information that we'll have in this report relates both to business strategy and to risk management, but also to governance. And maybe I can say a few words about what we expect to see in the report that we will produce in June and why we think this sort of sets some expectations for individual banks. And again, for an audience in Korea and globally, I think these are themes which are not unique at all to Europe, but are absolutely crucial across the world, and it's work in progress that we are seeing everywhere. So if I maybe can explain a little bit more about what we intend to see in this report. So, simply starting with definitions is a really important message, I think, because again, when we have this discussion about ESG factors and we can all start to find some common ground on, so what's in environmental factors? How does climate change impact? Are we also talking about biodiversity? But when we've done that, we also need to think a little bit more about what are the risk drivers. So how do you articulate, for example, from climate change better the physical and transition risk? And how do these work through transmission channels to impact the financial soundness of institution? So, for example, you may have physical risk, and I gave the example of a floodplain earlier, that works through an impact on the collateral of real estate to impact negatively, perhaps, capital, solvency, profitability in the future. So making sure that we have these common definitions is important. I think then trying to consider what data do we have today? What are the data gaps that we identify and how can we address them is crucial. I think I explained this a little bit in relation to the balance between banks needing to get information from their customers in order to build their own data sets. So working with their customers to provide information about the sort of classification of activities, provide that information to the bank so that they can build a basic data set with some key metrics, and then use that to evaluate their risks. And in the report, we expect to talk about the different ways of analyzing the potential risks. So it could be that you talk about portfolio alignment. So you would look at a portfolio and say, how aligned is this with Paris Agreement goals? How far off are we? It could be that you look to a risk framework method. And I'll give an example of this in a moment, where you take the risks as a whole and you say, okay, within our portfolios, what happens over a long period of time if certain scenarios occur? So some scenario analysis to understand the sort of risks, physical and transition risks, but other risks to an institution. Or it could be that you actually just drill down on an exposure method to look at every individual counterparty and every individual loan and understand a little bit what the risks are today. So what is the categorization? So the portfolio method, you might argue, is strategy aligned. The risk framework method is very risk aligned, whereas the exposure method is a little bit more sort of backward looking, just to understand the appropriate classification. I believe these are not mutually exclusive, and we see them being used in different ways by different banks, but I think it's important that we set out some common understanding of this. It will also be important that we set out some common understanding of ESG risk management. So, how do you build ESG factors into your risk management? Who is looking at those in the institution? What sort of tools do they have in order to measure, monitor, and mitigate those risks? I think that will be something key, that we articulate expectations for financial institutions. And finally, we will look a little bit at how ESG risk supervision should be taken forward. And I think one of the key factors here is that, again, as I was saying, with risk management, supervision will maybe need to take a slightly longer time frame to understand how to correctly factor in ESG factors as drivers of financial risk. Maybe I can give an example of this sort of risk framework approach that we have undertaken in the European Banking Authority, still under the sort of broad context of Pillar 2 and risk management, which was a sort of scenario analysis that we did. But what an interesting point that we found from a group of volunteers that we worked with was trying to do scenario analysis. The most important part was actually trying to do the classification of loans. And it was incredibly complicated and difficult to do that classification. And we had to use proxies and estimates. And I referred to proxies and estimates earlier in relation to disclosure. But we had to really make some estimates of the kind of classification. And on the risk side, we found broadly that more than half of the classification was actually relevant for climate policy issues. So we had exposures to manufacturing, electricity, transportation, construction, and we were able to look at what that meant from a climate change perspective. And conversely, on the strategy side and the sort of allocation of loans that would meet Paris-aligned activities, what we call the green asset ratio, it was very difficult to do this classification. But as a reflection more of the economy, perhaps, than of individual bank choices, we saw that the green asset ratio tended to be, reasonably low. So often in single figures, often under 10 or around 10%, which I think is a fascinating starting point. But for me, again, this is less about what does that mean for individual banks. It is about what does that mean for the structure of the economy today, and how do we understand then the movement, the transition that is going to have to take place between now and 2030, and then 2030 and 2050 in order to meet Paris-aligned goals. This is a starting point, but it gives you a flavor both of some of the challenges we have in getting data and classification, and some of the challenges we're going to have in adjusting these portfolios to meet the agreed social goals. So I've covered pillar 3 and the absolute vital need now for disclosure of at least some key metrics, both around risks and green asset ratio. I've explained the work that we are doing now in order to inform in the future adjustments to expectations for risk management and also for the supervisory process. And of course, on all of these, it's absolutely vital that we do the work in individual jurisdictions, but that we also collaborate internationally through the relevant forums, such as the NGFS, such as the Basel Committee, also paying close attention to the work of the G20, of the accounting standard setters, in order to find common ground. And I said that we'd sequence the work so that we started with pillar 3, then we're moving into pillar 2, and then pillar 1. And I think this is really interesting because the pillar 1 work is where we look for evidence of actual risk differentials based on specific ESG criteria. And we're still, I would say, very much in the exploratory phase of this work. One of the interesting things that I have seen is that when we first started talking about the ESG work that we were doing in the EBA in 2016, 2017, there was a strong pressure to identify some capital differentials to make it more attractive for banks to lend to ESG type investments. And what we have seen is that, in fact, the impetus has changed a bit. And in particular, I think it's changed in the last couple of years. One, as we have seen the evidence around climate change in particular mount, but also I think as a result from the pandemic, and we're looking to green recoveries, there's a real desire by banks, boards, and others, both to undertake sustainable lending, but also to demonstrate that they're undertaking sustainable lending, which is why I think that the disclosure part is so important, the risk management part is so important, and actually there's a little bit less impetus to provide incentives for that green lending. But of course, there is still a great interest in the empirical evidence as to whether there are differences in risk in relation to ESG factors. So this work remains important, but it is necessarily sequenced. They're also necessarily sequenced because we need the metrics in order to understand where we are and where we want to go. We need the metrics in order to understand how we're going to manage and monitor those risks. And it's only when we've got the metrics that we can actually start to understand and look at the risk differentials. And so that's another reason why we have this work sequenced in this way. So we are looking at this at the moment. We are looking to understand riskiness and exposures, and also understand the range of prudential tools which may ensure an appropriate risk-based treatment. So it could be that there is some relation to capital. It could be there is some relation to other tools that supervisors have in Pillar 2 or in relation, for example, to large exposures. I don't know the answers yet. This is work in progress. Our current legal deadline for this sort of capital differential work is 2025. I expect that we will be moving sooner than that because it is important that we get the evidence out there. And it's also important when we look at this evidence that we don't simply look at existing historical data, but we understand how that data may change over time. And in particular, I think there is some very interesting transition risks that are very difficult to pick up with historical data, especially as public policy may change very quickly. So, well, I've very much enjoyed talking to you about the work that the EBA is doing on ESG risks. I've tried to explain why I think the ESG factors are so important for banks, for supervisors, but also for the broader public. And this issue of dual materiality really shows a heightened interest from all stakeholders in the work of ESG, especially because we have an interest in banks from their own solvency, but also banks as either drivers or reflectors of what's going on in the broader economy are absolutely key from a societal perspective. So I've tried to explain how important it is. I've spent most of the time talking about the sequencing of the work that we will do. And I think the sequencing of the work that we're doing in Europe is also relevant in terms of the work that we're doing internationally. So our sequencing has been Pillar 3, in the sense of getting some metrics and making sure they're disclosed. Pillar 2, in terms of improving risk identification, management, and mitigation. And then Pillar 1, in the longer term, any evidence of risk differential. And I also hope that I've tried to explain the way that we are working in the EU in the context of the broader international work. Because for the audience today, I think I understand that there is a great interest in ESG. There's a great deal of knowledge, and it's absolutely imperative that we work together because the ESG risks themselves cannot be confined to one jurisdiction. It's a global phenomenon, and it's absolutely imperative that we work together. And in order to work together, we need to cooperate, but we also need to find ways of making sure that what we're doing is consistent and comparable. And I'm going to stop there. So thanks very much indeed.
네, 고맙습니다.
Thank you very much, Director Haben. He has talked about why ESG is important in the financial community.